Hey guys, what's up? Welcome back to The Impeccable Investor. The vast waters were never as tempting as they are to yachties right now. The Association of the Cruise Ship Industry expects a record 27.8 million passengers to take a cruise in 2018, up from 25.8 million tourists a year before. For more than a decade, that number has been gradually moving higher annually. The leading cruise lines bring out more vessels with higher capacity and more technology. Here are 5 of the most profitable cruise stocks available. Carnival. The sheer scale of Carnival allows some fascinating benefits. It produces cruising-themed travel channels that push off peak hours to big stateside networks and a recent deal for Spanish-language programming with Univision. Carnival is also a mobile technology player with last year's unveiling of Ocean. The wireless, enhanced passenger appliance helps passengers with anything from mobile food and beverage orders to personalizing cabin designs. In its recent quarter, Carnival sold with lower earnings due to unacknowledged profits and losses on fuel products and other net charges. Fuel is a big item of expense for cruise ships, and attempting to hedge the uncertainty often produces puffy members. Back those charges out, and the adjusted earnings per share of Carnival continued to decline 6% over the period. Still, things are better than they are. It was an active hurricane season, and Carnival estimates that income for the quarter that wrapped in November would have climbed decently if not for the damaging windstorms. Things are looking pretty good in the future. Royal Caribbean, they are threats. But suppose you're the type of risk-averse investor who would rather buy the match winner in an out-of-favor industry than buy a steamy industry laggard. In that case, you could perhaps discover Royal Caribbean stock to your taste. That Royal Caribbean has stayed up better than Carnival and Norwegian Cruise Line, and this is no coincidence. It's not the dominant winner, wearing that specific crown and title as Carnival, but being the silver medalist in terms of volume is a wonderful sign. Historically, Royal Caribbean controlled the thickest earnings in this market. Looking at 2022, the year investors see a return on growth for all 3 players. Royal Caribbean will be the closest to its peak earnings for 2019. With its positive signs, Royal Caribbean is in a unique win-win situation. If things improve, this will bounce back first. The stakeout will eliminate some of its competition if markets crumble, boosting long-term prospects at the cost of short-term outcomes. The revenue for the fiscal year 2019 was about $11 billion. Fiscal revenue for 2022 is projected to rebound to about $10.5 billion. Operating margins were about 19% in 2019. They are anticipated to recover to 15% in 2022. Under certain hypotheses, the analysis indicates that $6 in 2022 return on equity is feasible. Based on a culturally average 13-fold forward earnings multiple, this suggests a 2021 RCL stock price targeted should be $78. That's about 50% from where RCL's stock is currently trading. Norwegian Cruise Line. Compromising 3 brands such as Norwegian Cruise Line, Oceania Cruises, and Regent 7 Seas Cruises, this name operates 28 crafts in the Caribbean, Europe, Alaska, Australia, Bermuda, and other regions. Even though COVID-19 threats have shoved down shares by 76% year-to-date, reports and rumors suggest that investors should buy NCLH based on their solid event direction and positioning. Shiken points that NCLH has recently increased liquidity in not 1, not 2, but 6 different ways. Those involved got a debt break from its export finance partners. Suspending amortization payments added $905 million in liquidity. An acquisition from private equity company L. Caterton, and offerings for a bond, convertible debt, and other treasuries. In addition to this, the company has already finished 2019 with funding of $1.8 billion. Saga plc. Insurance is a loyalty-dominated market. Given the drive for buyers to become more aware of the advantages of switching insurers, many people often stick to the same policies. The role of Saga as a main insurance provider for over 50s gives it a degree of visibility and recognition that many firms envy and can provide the business with much-needed continuity. It takes the measures it needs to take to ensure. For Saga, it was a rough couple of years, but maybe things look better. In any case, investors are beginning to look more favorably at a firm with a low valuation and more interesting technical outlook. Much remains to be achieved, but the shares now appear to give greater value than they did back in 2017. Viking Line. Viking Line ABP is a Finnish company dedicated to providing passenger and freight services in the northern Baltic Sea. It also provides onboard facilities such as shopping, food, and professional hotel and entertainment. The operations of the company are subdivided into two working segments: vessels and unallocated. The operating category of vessels, the main revenue driver, includes direct income and expenditures, including depreciation and amortization, due to the vessel's service. The unallocated operating section primarily covers unallocated marketing and administrative expenses. The group's company is conducted primarily via Finland. This brings us to the end of our video. I hope you enjoyed it. Hit like if you did, and don't forget to subscribe to our channel so that you don't miss any of our videos in the future. Also, watch the two videos that are on your screen because I'm sure you'll love them. With that, I'll see you in the next video.